reduce your tax burden? I know that you're always thinking of strategies to help clients reduce their taxes. So let's talk about those required minimum distributions because proper planning is vitally important. Let's start real high level. What are RMDs and how are they calculated?
Absolutely, Erin. So RMDs are required minimum distributions, just like you said. They're required by the IRS. Basically, they make you take distributions once you reach a certain age. It used to be about 70 and a half, and now it's 72. So
Mhm.
that was a recent change. So if you haven't yet aged in, it's 72. And the formula is pretty straightforward. They look at your total IRA, so traditional IRA balances. This includes 401ks, traditional IRAs, simple IRAs, uh, whatever it is, as long as it's a traditional IRA balance at the end of last year, so December 31st of the previous year. And then they look at your age. So starting at age 72, you're looking at a roughly 3.6% and change amount that you have to take out. Okay.
Mhm.
So if you are turning 72 and let's say you have $1 million in your 401k, that's going to be $36,000 in change that you're going to be required to take out that first year. So most people don't plan on these.
Mhm. And I know that you also that work really hard to make sure that your clients do take them when they need to, because if
Yeah,
they don't, there is a very significant penalty.
for sure. The penalty is about 50% of the amount you were supposed to withdraw
Ouch.
for the year.
Yeah.
And then you still have to make the withdrawal. So it's not
Ugh.
fun
I'm glad you do that reminder because that would stress me out.
for
So
sure.
let's run through the three strategies then to reduce the tax burden that comes with RMDs. And the first consideration here is possibly taking early distributions. Why is that?
So this is an interesting one, and it's not right for everyone in every scenario, right? But it is a potential avenue. So if you're really ahead of the curve on your planning and you want to get started early, you can start to begin taking withdrawals out of most of these traditional IRA accounts as early as age 59 and a half.
Hmm.
And so what that allows is basically a longer runway up until age 72. And you can kind of get ahead of having that big ticking time bomb that's the RMD, especially if you're not going to need it when you do turn 72. Now you're kind of just playing a tax game where you're trying to minimize what you're pulling out every year. And you can use it on kind of like a Roth conversion strategy.
Mm.
So with the Roth IRAs, I mean, you know that you've got a maximum amount that you could put in every year. And some folks are disqualified if their income is too high. They can't even contribute to a Roth IRA of their own. But you
Hmm.
can do a conversion, which basically entails converting a portion of your traditional IRA balance into a Roth IRA balance. You're paying the taxes now, right? So it's not a free exchange, but you're paying taxes now essentially to avoid paying taxes later on. So this is another one of those things that's not right for everyone, but it is a good planning tool. And if you're in a position where you're far enough away from your retirement and you've got 5, 10 years that we can plan this out, it may make great sense. It's one of those things that you really don't want to do in one year because
Hmm.
all that, every dollar you would draw out of these IRAs is taxable income.
Hmm.
So if you have a $400,000 IRA and you're 64, or you want to retire at 65 and you do the whole Roth conversion, it looks like you made 400 grand that year. And that's
Hmm.
just not worth doing at that point.
Yeah, that's a lot. Yeah, Roth conversions. The second strategy there also, Kyle, because Roths don't have any required minimum distributions, right?
Absolutely. Yeah. So you get to step that aside altogether. And then, Social Security is taxable. So if you're
Hmm.
not at Social Security age yet, you may not know this, but if you make X amount of dollars, and I believe it's for married couples right around 44,000, you make more than that, 85% of your Social Security check is going to be taxable, counted as taxable income.
Right,
So if
right,
you've got all Roth balances, that's not part of that calculation. So that could
right.
be a huge save. And Medicare
Yeah.
Part B, that's another
Mhm.
little thing to keep in mind.
And the third strategy here, qualified charitable distributions, QCDs. Why are they an important consideration?
This is a little bit more on the advanced side of the tax planning that we do with clients. But for the clients that are charitably inclined, let's just say you contribute to your church, or you donate to your church every year,
Hmm.
right? If your church is a legitimate charity, right, it's 501c3, you can basically route your RMD, part of your RMD, or if it's perfect, it's all of your RMD, right, straight to the church. And at that point, it's considered a charitable donation, and it's a qualified charitable distribution, and it's not taxable as income to you. So it's a way of, if you don't need the RMD money, it's just going to sit in the bank. You can basically offset having that as your taxable income by going straight to the church
Such
or
a
the
win-win.
charity.
Yeah,
Yeah.
I like that one. And again, this all just comes back to strategic tax planning because those RMDs, as you mentioned, are considered income. And that brings us back to a very common misconception that people think they're going to be in a lower tax bracket when they retire.
Yep, and that's not necessarily the case, just like we spoke about. And the thing with these is there's no one size fits all. There's no one solution that's good for everyone. It is very, very detailed and customized when you get down to it, especially with the QCDs. You want to calculate your RMDs ahead of time, work with your advisor, and make sure that everything you're doing is legitimate and by the book.
Right, Kyle. Thank you so much for explaining that because I think that a lot of these strategies, the earlier the better when you can start
Absolutely,
planning for them.
absolutely.
So if somebody has any questions about something that we've covered today, what's the best way to reach you?
Best way to reach us is through our website. That's firstcoastfinancialgroup.com.
All right, Kyle, thank you very much.
Thank you, Erin.